For decades, the US dollar has been the bedrock of global finance. It has served as the world's primary reserve currency, trusted by governments, banks, and investors across continents. The dollar's dominance has allowed the United States to borrow at low costs, influence global trade, and shape the rules of international finance. Its stability has been a source of comfort during times of crisis, acting as a safe haven when uncertainty strikes. But beneath this apparent stability, silent tremors are growing stronger. Subtle shifts in global sentiment are beginning to ripple through the financial system, hinting at changes that could reshape the world economy. These tremors are not always visible, but their impact is becoming harder to ignore. China, the world's second-largest economy, is re-engineering its financial strategy, moving away from US government debt. This is not just a financial maneuver, it's a calculated move to reduce dependence on the dollar and assert greater control over its own economic destiny. By gradually selling off US bonds and increasing its holdings in other assets, China is signaling a new era in global finance. This shift questions the old rules and suggests a future where the dollar's dominance is uncertain. Financial experts and policymakers are now debating what a world with multiple reserve currencies might look like, and how it could affect everything from interest rates to international trade agreements. Nations around the globe are reconsidering the safety of holding reserves in a rival's currency. Central banks are diversifying their portfolios, adding gold, euros, yen, and even digital assets to their reserves. This diversification is a hedge against geopolitical risk, and a sign of waning confidence in the old order. Beijing's diversification lays the groundwork for a multipolar financial world, where no single currency holds absolute sway. This new landscape could bring both opportunities and challenges as countries navigate a more complex and competitive environment. The implications are enormous, challenging the US's ability to borrow cheaply and maintain its influence. If demand for US debt falls, borrowing costs could rise, affecting everything from government spending to mortgage rates for ordinary Americans. The global financial architecture is showing its age, and China is testing its limits. As new players emerge and old alliances shift, the foundations of the system are being re-examined and, in some cases, rewritten. This is a story of strategy and national security in an uncertain world. The choices made today will shape the balance of power for decades to come, influencing not just economies, but the very fabric of international relations. As of October 5, 2025, the world stands at a financial crossroads. The decisions of nations, investors, and policymakers in the coming years will determine whether the dollar remains supreme or if a new era of financial multipolarity is about to begin. China, once the US's biggest foreign creditor, has long played a crucial role in the global financial system. For years, China's vast holdings of US Treasury bonds symbolized a deep economic interdependence between the world's two largest economies. But now, a significant shift is underway. China is steadily reducing its US Treasury holdings, a move that's sending ripples through international markets and raising questions about the future of global finance. This isn't a sudden fire sale or a panic-driven exit. Instead, it's a carefully planned, methodical unwinding of what China now views as a risky position. Chinese policymakers are weighing the long-term risks of holding so much US debt, especially as global tensions and economic uncertainties rise. Rather than reinvesting in new US debt as old bonds mature, China is simply letting those bonds roll off its balance sheet. This gradual approach avoids market shocks while still reducing exposure. At the same time, China is aggressively accumulating gold, a neutral asset that isn't tied to any single country's currency or political system. Gold has long been seen as a safe haven in times of uncertainty, and China's purchases are among the largest in the world. This dual strategy, reducing US debt and boosting gold reserves, helps China lower its exposure to US financial and political risks. It's a way to insulate its economy from potential sanctions, currency fluctuations, or other shocks that could come from Washington. Gold acts as a hedge against currency devaluation and geopolitical instability, providing a buffer if the dollar weakens or global tensions escalate. For China, it's a form of financial insurance. These actions signal a growing loss of faith in the US dollar's long-term stability. As the US faces rising debt and political gridlock, China is rethinking its reliance on the dollar as the backbone of its reserves. China's unwinding is more than just a financial maneuver, it's a strategic repositioning that's resonating with other countries. Many nations are watching closely, considering similar moves to diversify their own reserves. The numbers tell a compelling story. China's US Treasury holdings are at their lowest in over a decade, while its gold reserves are hitting record highs. This shift marks a new era in global finance. Ultimately, this is not just a financial transaction, but a global strategic move, one that could reshape the balance of economic power for years to come. China's financial strategy prioritizes security over profit. The Western response to Russia's invasion of Ukraine was a wake-up call. Freezing Russia's reserves showed the power of US financial control. For China, this risk is real, especially concerning Taiwan. With over $3 trillion in foreign reserves, China seeks to reduce vulnerability. The shift to gold and other currencies is a defensive measure. It's about spreading risk and ensuring no single country holds China's fortune hostage. This marks a break from globalization driven by economic efficiency. National security concerns are reshaping the global reserve system. China's strategy is the leading edge of financial fragmentation. The US enjoys the dollar's reserve status, a privilege that allows it to run massive deficits without immediate repercussions. This unique position means that the US can borrow extensively, funding its spending by issuing debt that is eagerly snapped up by investors worldwide. The dollar's dominance in global trade and finance underpins this system, creating a cycle of dependency. This system relies heavily on the global willingness to buy US Treasuries, which are seen as a safe investment. Investors from all corners of the globe, from individual savers to large institutions, have historically flocked to these bonds, trusting in the stability and reliability of the US economy. However, China's recent actions expose a significant vulnerability. As one of the largest holders of US debt, China's decision to reduce its holdings signals a shift in confidence. This waning foreign demand could have far-reaching implications for the US financial system. A funding gap begins to open, putting pressure on domestic buyers and the Federal Reserve to step in. The Fed may be forced to purchase more bonds to stabilize the market, a move that could have unintended consequences. Printing money to buy debt risks, devaluing the dollar, and stoking inflation. This approach, while providing short-term relief, could lead to long-term economic instability, as the value of the dollar diminishes and prices rise. This creates a dangerous feedback loop, where rising debt levels and inflation feed into each other, potentially leading to a full-blown debt crisis. The consequences of such a crisis could be severe, affecting not just the US, but the global economy. Rising debt and waning foreign demand test America's economic strength and resilience. The US must navigate these challenges carefully to maintain its position as a global economic leader. What was once considered an exorbitant privilege could become an exorbitant burden, as the weight of debt threatens to overshadow the benefits of the dollar's reserve status. Global trust in the US is being tested like never before. As international leaders gather to discuss economic strategies, the reliability of the US as a financial partner is under intense scrutiny. The foundation of America's economic strength is under scrutiny, as economists and policymakers debate the best path forward. The decisions made today will shape the future of the US economy and its role on the world stage. The US stock market appears strong, but the real economy strains. This disconnect creates a false sense of security. Asset prices are inflated by low interest rates and liquidity injections. Real wages stagnate, and economic growth relies on deficit spending. The stock market reflects monetary policy, not economic health. This situation is unsustainable. Fundamentals matter. China's perception of weakening US fundamentals drives its strategy. The economy's dependence on financial engineering is a concern. The dollar's status as a long-term store of value is questioned. China diversifies its reserves into other global currencies. The euro, British pound, and Swiss franc are key beneficiaries. This shift spreads financial risk across different blocs. Strengthening ties with Europe counters US influence. A basket of currencies emerges as a viable alternative to the dollar. Increased demand for these currencies strengthens them as reserve assets. the dollar's dominance could erode through the rise of alternatives. This diversification has profound implications for global finance. The gradual rise of credible alternatives challenges the dollar's status. The dollar's position as the world's reserve currency faces doubts. Soaring U.S. debt and political polarization erode trust. Financial sanctions show dollar assets aren't neutral. The economic case for the dollar weakens with constant money printing. Savvy investors see a country diluting its currency. The rise of alternatives challenges the no alternative argument. A multipolar financial system is emerging. The dollar's reign may be entering its twilight. It may remain first among equals, but its dominance is questioned. The global consensus on the dollar is fragile. The end of the dollar's reign would be a seismic shift. A multipolar currency system could emerge, sharing reserve roles. The US dollar, euro, and Chinese yuan might form a new reserve basket. This system could be more balanced, but also more volatile. A neutral reserve asset like gold could play a key role. Digital currencies and supranational currencies are potential alternatives. The transition affects global prices, savings, and jobs. A disorderly end to the dollar's dominance could trigger a crisis. The path forward is unwritten, with high stakes. China's moves today are the opening chapter of a new economic era.